Hello RFM 315 people. I wanted to take time to create a video for you to add to some of the content beyond what the textbook provides for you. So to begin, we're going to talk about three types of financial ratios. The categories are solvency, liquidity, and profitability. And they're all really important to you as professional business managers. Some of you currently, some of you hope to become entrepreneurs or to manage business for an entrepreneur someday. So these are going to be really important. So let me define and give you an example of each of them, and then your homework will ask you this week to dig into some of them, and in future weeks to come you'll dig into more. My goal is that you'll, 1, comprehend what each of them means, that 2, you'll be able to give an example of a solvency, a liquidity, and a profitability ratio, and you'll know where to find the information on which of the financial documents that a business typically uses, and 3rd, that you'll be able to interpret what you find out from the ratios and determine financial health of the particular business that you're studying, or maybe that you work for and in. So when we talk about solvency, we look at an example might be of a solvency ratio, might be debt to equity. Okay, debt to equity will kind of reveal to us, and these solvency ratios will reveal to us a bit about the capital structure of the business. Now, when I say capital structure, you can only own something 2 ways, right? You can own it with your equity, what you own, or you can own it with debt, what you owed someone or took a loan with someone in order to buy that asset. So to begin with solvency and debt structure, let's talk about an asset, because we understand now, some of you had to review and recall what you learned in accounting, but you understand that the balance sheet lists assets and liabilities, and that accounting equation tells us that assets equals liability plus shareholders' equity. So let's pretend that one of you wants to buy a food truck, okay? So if you wanted to buy a food truck, and let me switch around here, here's the food truck. It's going to be a box truck because I'm not a great artist. And in order to buy this food truck, the price is $10,000. So that in essence would be our asset, right? So to get that, there are only 2 ways. Let me move out of the way. Hopefully that's better. There's only 2 ways that you could get this truck. I mean, you could argue that there's a lot of ways someone could gift it to you, but if they gift it to you, then you own 100% of it. The equity is all yours, right? So you can either have some of the money, meaning that you own some of this, and if you don't have the $10,000, or if it wasn't gifted to you, then you need to take on debt. Right? So the capital structure is how much of the assets are made up of debt and equity, okay? So if we're looking at this, we can have your equity, maybe you saved $6,000. So you have that in a bank, you go, you get a cashier's check for $6,000. Well, unless you're a really good haggler, the price, let's assume, is staying at $10,000. So you don't have enough to buy this. So what does that mean? 10 minus 6, you still need $4,000. So you go over here to this bank, and you say to the bank, I need $4,000 to acquire this $10,000 asset. So the bank gives you $4,000. So your capital structure for this business that you created is that you're 60% equity and you're 40% debt, right? So this tells us that you have one asset, and here's the capital structure, or how those assets have been purchased. They can only be purchased with equity or with debt over here. And debt we like to call liabilities in the financial world. So if we're talking about an example of a solvency ratio, we can talk about a debt to equity ratio. So that formula, debt to equity ratio, is going to equal your total long and short-term debt, so total debt or liabilities over total shareholders' equity. Now, to interpret this, if the number is 1 or greater, that's going to tell us that the firm has more debt than they have assets or equity, and that might give us some clues as to, well, what happens if there's a slow period or a loss in sales somehow? How will this company be able to cover the long-term debt payments if they're debt heavy? This may also, a bank may use this, or a creditor or an investor may look at this and say, I'm not comfortable with your debt to equity ratio because you are too debt heavy to be a good risk. The second type of ratio we're going to talk about are liquidity ratios. And for liquidity ratios, what I like to say is, in order for something to be liquid, how fast to cash. And in finance, how fast to cash or how fast to liquid is a year or less. So you find a lot of this information again on the balance sheet. And one of the ratios that we look at to reveal liquidity information about a business is the current ratio. And you'll be working on the current ratio for an assignment this week. So to calculate the current ratio, you'll look at the balance sheet and you will take total current assets over total current liabilities, okay? So the second one is the current ratio. So what does this tell us? What does this tell us about a business? This tells us how well the business can do at paying current bills that are due with the assets that they have, the current assets. And don't forget, current assets are things that can be quickly converted to cash. So cash is a current asset, accounts receivable can be current assets, inventory can be current assets, because we hope to quickly convert those to cash. And if we're in the restaurant business, inventory, we hope it's very perishable, so we hope to convert that to cash very quickly, right? Okay, so the third type of ratio we're going to talk about is profitability. And this will tell a financial analyst or a business person how well is the company doing at generating profit from sales. Now, the information that you need in order to calculate, sorry about that, you guys. I don't know how to block these pop-ups. If you want to send me an email, tell me. The place that we look at to find pieces of information to use to calculate profit margin, which is a profitability ratio, is the income statement. And where we want to look for that, so the profit margin ratio is net income over total revenue. Okay? Revenue. Okay, so where do we find net income? What is net income? If we're going to refresh your memory, net income is profit. It's what's left after we take revenue and we subtract out the cost to produce those sales, cost of goods sold. Then we get gross profit margin, if you recall. Then we subtract out all the operating expenses. And just for the sake of this class, after that, we would come up with net income. Okay, so net income over revenue, this should probably be expressed as a percentage. You guys are in a restaurant bachelor's degree program, so you know that we want this to be about 10% or greater. So if you're looking at this and this is 1% or 0.5% or 3%, you can immediately look at this ratio, which is a profitability ratio, and diagnose that this business is not currently doing a good job of creating profit based on sales. So let's just chunk this out and talk about these for this week. As the weeks come, we will dig into deeper ratios. We'll identify them. We'll tell you where to find them. You'll calculate them. You'll analyze them. And then you'll make an assessment. You might make an assessment on what do we have to do to increase profit. Are we in a position to take on more debt based on our current capital structure and solvency? Do we have the ability to pay current short-term debt with the amount of current assets we have? And we'll dive deeper and deeper. If you have any questions on these, be sure to read the additional material that I have posted under this week's reading. Scroll down and you'll see an article with some great explanations on these ratios, what they mean, which category they fall under, and specifically the ones I want you to concentrate on this week. You have an assignment that'll have you practicing finding important information on the income statement and the balance sheet, getting used to reading financial documents, and then doing some really quick calculation of ratios. And in weeks to come, we'll start the fun part, where we will analyze and make decisions for the business based on what numbers in finance tell us. Have a great week, you guys. Reach out to me if you need me, and I'll see you soon.